Hey, this is Matt, co-founder of Universal CPA Review. Thanks for checking out our video here on the equity method, which is a complex topic tested on the CPA exam. So before we dive into the lecture video, please subscribe to our YouTube channel. It makes a huge difference. If you want to join our Facebook and Reddit study groups, the links are in the description. And then we also have a free trial. You'll receive full access for 7 days, so give it a go. Now let's get going with this video on the equity method. I want you to focus super hard right now because this is a very important module on the equity method. Now at a high level, we're going to go through the overview of what the equity method is and when it's applicable. We're going to talk about our mental map, our 5-step approach, and go through an example. And then we're going to finish it off with some other miscellaneous items related to the equity method. Now, the example we're going to go through is very similar to a simulation. And guess what? All the different 5 steps we're going to talk about, those will answer the various types of multiple choice questions you could see. So this is going to be a super representative lecture of the types of questions you'll see for multiple choice questions as well as simulations. So like I said, pay close attention here. So when we invest in another company, meaning we buy an equity security, which could be common stock, preferred stock, or other types of securities, well, it depends on our ownership or if significant influence exists as to whether the equity method is applicable. We previously talked about the fair value of the cost method, which is applicable when we own generally less than 20% of that company or significant influence does not exist. Now, if we own between 20 and 50%, it assumes that significant influence exists, but the equity method can also be applicable if we own less than 20%, but significant influence does exist. If we own more than 50%, well, that's going to be covered in the next module, and that's called the acquisition or consolidation method. So what is significant influence? Well, it's exactly like it sounds. Do I have the ability to influence significant decisions that you would make as a company, right? So the official definition says it occurs when an investor has the power to participate in the operating and financial policy decisions of an entity. Right, so that's a pretty strong wording. What are some examples? Well, if we as an investor and we hold 20 to 50%, well, if we can act on behalf of management, meaning we make financial or operating decisions, that's significant influence. If we have a board of director role, well, we have the ability to direct the company, and so we would have significant influence. Or this company we invested in, they could be independent on us. And what's an example of that? Well, let's say that we own technology and the company we invested in relies on that technology. Well, if we pull that technology, that's going to be a big problem for the company, right? So we have significant influence on what they do. So when we think about how this is applicable in the real world, well, there's a lot of subjectivity, but for the exam, it'll be fairly straightforward. It will say something like significant influence does exist, or it'll give a very concrete example where you're going, okay, that's significant influence. If the question doesn't say anything about significant influence, then it likely doesn't exist. And then we could use either the fair value method or we can elect the equity method. Now, there could be certain situations where we own between 20 and 50% and we have significant influence, but the equity method will not be applied. A few examples could just be that the investment is considered to be temporary. Right? If we're going to hold it short term, then there's no reason to account for it under the equity method. What if the investee is bankrupt? Well, we probably wouldn't use the equity method. What if we don't get the necessary information to be able to actually apply the equity method, right? We need specific financial information for the company, and if they're not willing to give it to us, then it's going to be hard to actually apply the equity method under US GAAP. And then we could also have a standstill agreement in place, which means we own more than 20%, but we signed an agreement saying we basically have no ability to influence the operating or financial policy decisions of the entity. Right? So when a standstill agreement is in place, then we would not use the equity method. We would use the fair value or cost method. Right? So Keep in mind those examples where the equity method is not applicable, but what you'll find is most questions really relate to just applying the equity method. And that's where our 5-step approach for the equity method is going to become super important. So let's take a second to think about that and then dive into the 5-step approach. So here is our 5-step approach for the equity method. And trust me, these 5 steps will save your bleep, right? You know what I'm talking about. And that's because on the exam, you're going to see a question and you're going to have to apply these 5 steps to be able to figure out whatever it's asking for. If it's a simulation, you might need to perform all 5 steps to answer every aspect of the simulation. But if we understand these 5 steps, we'll be prepared for any type of multiple choice question that we could see. And you'll see that when you go practice the multiple choice questions and we apply the 5-step approach. So let's go through the 5 steps. So our first step is to record the initial transaction, which is the investment. Right? On a specific date, we'll make the investment. We'll buy the equity in this company. And we'll pay a certain price per share. Now, overall, we're concerned with what is the total purchase price. That's our initial cost. But we also have to include direct acquisition fees. If we, incur some type of legal or diligence fees, those should be included in the total investment in investee balance on the balance sheet. Right? But we need to understand there's 2 different components, right? There's the purchase price, which could be different from the total investment in investee. Now, more often than not, they'll just tell us the total purchase price, and we'll have to assume that that includes any direct acquisition fees. But if they break it out, just make sure you remember to record them both. And to record this initial transaction on the balance sheet, we would just debit investment in investee and then credit cash. So overall, we're early on in the transaction. This is our acquisition date. We're very happy with our investment because guess what? This investment's going to the moon. We've all heard about going to the moon with our investments. We're going to make a ton of money, right? Well, hopefully that's the case for everybody that invests, but we know it's not. Overall, this is the first step and very important to get this right because the rest of the transaction is going to be hinged on getting this right. So step number 2, this is after we've acquired the investment and the investment or investee, they say, hey, we generated net income or net loss. Well, unlike the fair value method where we just take the change in fair value, instead under the equity method, we are going to record our share of either net income or net losses. So 100% of the subsidiary would say, here's what the net income or net loss is, but we only care about what is our percentage that we actually own. So you'll see this in an example later, but based on our share of earnings or losses, that is what impacts the income statement as well as the balance sheet. Right? So when we think about recording a share of net income for this step 2, well, if that's the case, we would increase our carrying value of the investment on the balance sheet by debiting investment in investee and then crediting equity and earnings income. Right? So this is sort of like just another gain that would go on to the income statement. It's the share of income that we're going to recognize in the income statement related to this investment. So if we had a net loss, well, we would credit the investment in investee account, which reduces the carrying value of the investment on the balance sheet, and then we would have equity and earnings losses, which are basically a loss in our income statement, reducing overall net income. So make sure you understand that we record the share of net income or losses. Now, step 3 focuses on recording our share of dividend distributions. Now, unlike the fair value method, where we had liquidating and non-liquidating dividends, everything is assumed to be a liquidating dividend under the equity method. So every single time we receive a dividend, that's going to reduce the carrying value of the investment in investee on our balance sheet, right? So that's why it's always going to be a credit to the account, and then the offsetting debit would be the cash that we are receiving from our investment. So fairly easy to remember, but when it comes to dividends, those are always going to reduce the carrying value on our balance sheet. Step 4 is arguably the hardest aspect of the equity method to understand. And it's basically because if there's a difference between the fair market value of net identifiable assets and the net book value of net identifiable assets for the company that we're investing in, well, there's what's called an amortization premium. So we're basically buying more into the company on the fair value than their book value, and that amortization premium is likely due to a difference in the fair value of a specific asset, like equipment, right? They carry it at their book value, but at the time of acquisition, we would record it at the fair value. Now, when we think about amortizing this premium, well, we have the total amount, and then we would divide by the remaining useful life, and that gives us the amount of amortization premium to record each year. Right, so this will make more sense when we actually go ahead and see an example, but the debit here is going to reduce any income from our investment, right? So remember step 2 where we credited that equity and earnings income? Well, what we're going to do here is actually debit that account, which reduces the income related to our equity investment, right? And then the offsetting credit is to the investment and investee account. And it's basically bringing it down to the book value. So a little hard to understand, but that's the general idea when it comes to step number 4. So one last thing to remember here is that this is going to be based on our percentage ownership. In the next module, you'll see under the acquisition method, it's based on 100% of the net identifiable assets for the company, regardless of whether we own 100%. But under the equity method, we're going to use it based on our percentage ownership. So it'll make a lot more sense when we go through an example, but this is just a brief introduction to step number 4. Step number 5 focuses on the application of goodwill. So similar to goodwill, if we bought an intangible asset, it's just the purchase price in excess of the fair market value of the net identifiable assets that we bought. Right? We can identify the assets that we bought, but then if we paid more, that difference, that excess amount is goodwill. And it's always hard to understand exactly what goodwill is. But again, the most important thing to understand here is that goodwill is not actually going to be reported on the balance sheet under the equity method. So we're not going to make any journal entry. It's just sort of tracked separately by the company. Because all we really care about on the actual balance sheet is the net book value of the assets as well as the fair value, right? We have that difference that we just talked about in step 4. But that excess amount that relates to goodwill is not going to be on the balance sheet. It's just going to be tracked separately, probably in a subsidiary ledger or an Excel spreadsheet, right? But it's not going to be found on the balance sheet. So those are the 5 steps of the equity method. They may not make complete sense yet, and I do not expect them to, but after we go through an example, trust me, they'll make a lot more sense. I just wanted to briefly introduce you to these 5 steps. So now we're ready to go through an example. Take a deep breath, because this is going to be very important. And again, we're going to apply these 5 steps. So here is our equity method example that we're going to go through. We've got Bear Corp and Salmon Corp. So on January 1st, year 2, Bear Corp, they purchased 40% of the outstanding common stock of Salmon Corp for $520,000. This works out to 5,000 shares at $104 per share. So 40%, that is considered to be significant, right? That's between 20 and 50%. Doesn't say anything about significant influence not existing. So we're going to assume that the equity method is going to be used here. Now, as part of this acquisition, they also incurred $40,000 of legal and advisory fees related to the acquisition of the common stock. So those are direct acquisition fees. That's not part of our purchase price, but that will be capitalized onto the balance sheet for our overall total investment in investee. So we'll keep that in mind as we go through step 1. The next sentence then says, on the acquisition date, the net identifiable assets of Salmon had a book value of $1,100,000 and a fair value of $1,200,000. So that's for 100% of Salmon. That's a difference of $100,000. Remember, we only care about our percentage ownership. Now it says that the difference is due to a machine that will be depreciated over a remaining useful life of 5 years. So we'll keep that in mind when we perform step number 4, but on the acquisition date, this isn't really important. It just becomes important later on. And then the last sentence says that for year 2, Salmon reported $200,000 in net income and paid a dividend of $5,000. So that's for 100% of Salmon. Remember, we only have 40%, so again, that's going to be very important to recognize because a lot of multiple choice questions will give you the values assuming 100% ownership, but you have to recognize that we only take pro rata or based on our percentage ownership. So we're going to go through all 5 steps and prepare the required journal entries related to this transaction. So starting with step number 1, we need to focus on recording the initial transaction on the balance sheet. So the purchase price, it told us, was $520,000, but we also have to include those direct acquisition fees for the legal and advisory. That was $40,000, so that means our total investment in investee that will capitalize on the balance sheet is going to be $560,000. So that's very straightforward, but very important to get correct because this is the initial carrying value of the investment, and it's our starting point that we have to get right for later on. So in step 2, this is where we record our share of net income generated by Salmon. So they generated $200,000, but that was for 100% ownership. We only own 40% as Bear. So our share of earnings, because it was income, would be $80,000. And remember what I said, we're going to increase the carrying value of our investment on the balance sheet for this share of net income. So we'll debit investment in investee for $80,000, and then our credit is going to be equity and investee income, and that's basically going to be a gain on the financial statements, right? Directly increases net income in the income statement. So that is how we record the share of income. Very important. More often than not, I would say that a question will say that the company generated net income. So always think about increasing the carrying value on the balance sheet. Now for step 3, this is where we record our share of dividends. Similar to net income, the $5,000 that was paid by Salmon, that's for 100% of the shareholders. Again, we only own 40% as Bear. So our share of the dividend would just be $5,000 times 40%, or $2,000. So the journal entry would be a debit to cash for $2,000, but then the credit is to investment and investee. This reduces the carrying value of the investment on the balance sheet. Very similar to a liquidating dividend under the fair value method. They're basically taking cash out of the company's retained earnings to pay dividends, but that's going to also decrease the overall value of the company. So that's why we're reducing the carrying value on the balance sheet for this share of dividend that we receive. So sometimes investors, they say, hey, hold on to the cash. You don't need to pay us a dividend. I'd rather you reinvest it in the company. But other times, investors want the dividend. Right, so for a company, that's a key aspect of managing their investors. All we care about for the CPA exam is that a dividend is going to reduce the carrying value of the investment in investee under the equity method. Now, step 4 is where we record the amortization premium. Remember, if we invested in a company where the fair value was higher than the book value of their net identifiable assets, then we're having a premium that we paid, essentially. And we need to amortize that premium over the useful life of the asset it relates to. So, tricky topic, but remember in the example, it says that the net book value of the net identifiable assets was $1,100,000 and that the fair value was $1,200,000. Well, that's a difference of $100,000, but that's at 100%. So if we multiply all of that by 40%, then we get what we see in the table here, which means the fair market value of net identifiable assets was $480,000 for Bear share. The net book value of 40% would be $440,000. that results in a difference to amortize of $40,000. Remember, it was related to a machine that had an estimated remaining useful life of 5 years. So each year, the amortization of that premium is going to be $8,000. What you may be thinking is that this amortization sounds a lot like amortization expense that we would record related to an intangible asset. And conceptually, this is correct, but we're not actually going to record amortization expense in the income statement like we would for an intangible asset. Instead, we're going to debit the equity investee income account. And if you remember from step 2, we credited that account when we recorded our share of net income. So this debit is going to offset any share of net income, right? So if we had a gain resulting from net income, well, this would offset that gain partially. And then the credit is reducing the carrying value on the balance sheet for that investment in investee. So again, tricky, but now is the time to really try to understand this. Where students mostly get tripped up is that they don't take the percentage ownership when applying it to the fair market value of net identifiable assets and the net book value of net identifiable assets. And then the other aspect is they think that it's amortization expense, but really it's just an offset to any share of net income the company would record related to the equity investment. So remember the journal entry and then work backwards, and it will make more sense. Now for step 5, this is the goodwill calculation. Now for the purchase price, it's not necessarily going to be equal to the total investment in investee that we recorded in step 1, because that could include direct acquisition costs. But if they just tell us the purchase price, that's all we have to go off of, but that's what they paid, and that amount, if it exceeds the fair market value of net identifiable assets, then we're going to have goodwill. And again, it's going to be based on our percentage ownership. So the purchase price was $520,000. Our share of the fair market value of net identifiable assets, which we calculated in step 4, was $480,000. So that means goodwill related to this equity investment is $40,000. But as you recall, there is no journal entry. This is just going to be tracked separately by the company. So no journal entry will be recorded. Now this is a great time to talk about the breakdown of the purchase price. Right, when we think about the purchase price, we paid $520,000. Now the book value of our share of the company's net identifiable assets is $440,000. In step 4, we determined that the excess fair value was $40,000. And then in step 5, we calculated that goodwill related to this equity investment was $40,000. So that's the breakdown of our purchase price that we paid, that $520,000. So that might be helpful to just understand step 4 and step 5 and how this relates back to the overall purchase price. But this is very important. All 5 steps are very important to understand. So just take a second to go back through, rewatch any of the specific steps, and go ahead and read the study guide. You'll see this again in a simulation, but all 5 of these steps will be touched on throughout multiple choice questions. So we talked through a lot of different journal entries, a lot of different aspects of the equity method, but we really need to understand what the ending financial statement impact would be for both the income statement and the balance sheet for year 2. Because as a controller or CFO, we're going to be looking at these numbers and saying, okay, these are correct. I feel really good about this. I feel good that every single aspect of this equity method investment was covered. So starting with the income statement, well, we talked about how we record our share of net income that would be generated by the investee, right? We would have recorded our share of earnings from that equity method investment in our income statement. And from step 2, we determined that was $80,000. But remember, in step 4, we also had to amortize that premium for that excess amount for the fair value to book value difference. And we determined that was $8,000, and that's going to basically offset our share of earnings recorded from net income, right? So our net impact to net income for Bayer would be $72,000. So that's what we would see in the income statement. So the income statement is not too tough, but the balance sheet, very important to understand. So remember our beginning investment in investee based on that initial transaction from step one was $560,000. Now we also recorded our share of net income, which increases the carrying value, and that's from step two, and that was the $80,000. Now in step three, we recorded our share of the dividend, and was similar to a liquidating dividend in the sense that it reduces the carrying value of this investment. And that's $2,000, and that's a decrease. And then for the amortization of this premium on the net assets, we just talked about that for the income statement. Well, it's also going to decrease the investment in investee on the balance sheet by $8,000. So if we add that all up and subtract, the dividend and amortization premium, that means the ending carrying value of our investment in investee was $630,000. So that's our comprehensive example. We went through all 5 steps. We also determined what the income statement impact would be, as well as the balance sheet. Very important to understand how this all flows together. We do have an Excel calculation that shows all the journal entries as well as these financial statement impacts. There's a link to it in the study guide. Just reach out if you have any questions or want a copy of that Excel file. Now we're going to talk about the impairment of an equity method investment. So it's really simple. At least once annually, what the company should do is say, okay, what's the carrying value of our equity method investment on our balance sheet? And what do we really think the fair value is? And if we think that there's a permanent decline in the fair value, then we need to write down this carrying value to the fair value and record an impairment loss. So the actual calculation for an impairment loss, very simple, but determining whether we should record an impairment loss is not as easy as it sounds, because under US GAAP, it basically says that there has to be a permanent decline in fair value. Well, there's a lot of reasons we could have a permanent decline, and it's not as simple as just the quoted price goes down. There could be other factors such as key customer losses, or technology changes, or working capital deficiencies, or they discontinued some businesses. Now, even those could happen, and the company could still be like, well, the fair value, it's going to go back up. So when it comes to determining whether there's a permanent decline in the fair value, or as US GAAP likes to say, other than temporary, then there is a subjective aspect of that. But for the CPA exam, you won't necessarily have to make that determination. It'll pretty specifically say there was a permanent decline in fair value. And then you'll just compare that to the latest carrying value of the investment, and you'll know whether there's an impairment loss or not. So let's look at an example, because that always clears up our understanding. Once again, we have Bear Corp, and they own 40% of the outstanding common stock of Salmon Corp. So as of December 31st, year 2, the carrying value of the investment in Salmon on Bear's balance sheet was $630,000. Now, flash forward to year 3, Salmon, they reported net losses of $50,000, and they did not declare any dividends. So we should be thinking about, okay, how does that impact the carrying value of the investment at the end of year 3? Well, we have to take our share of those net losses, so it's going to decrease. And remember, we're still continuing to amortize the premium for that fair value difference, which in year 3 would also be $8,000, and that's going to decrease our carrying value for the end of year 3. So it then says that during year 3, Salmon Corp lost 2 key customers. They must not expect to give them back. Now, Bear Corp, they're saying, okay, that impacts our assessment of the fair value. We now believe the fair value of this investment has permanently declined by the end of year 3 to $550,000. Right, so that's a permanent decline. We know why. Is that below or above the year 3 ending carrying value? So that's what we need to calculate first, and then we'll determine if there's an impairment loss or if there's not. So on the left, you'll see that our year 3 beginning carrying value for this investment in Salmon was $630,000. They told us that. And then we have to take our share of the net losses, which decreases the carrying value, And if they had 50,000 overall, we own 40%. That means our share is 20,000. So that's going to decrease the carrying value. And then we also have that amortization of the premium, which is 8,000, which decreases our carrying value. So that means our year 3 ending carrying value is 602,000. So now that we have the year 3 ending carrying value, we can compare that to the fair value that was assessed by Bear's management team. So 550,000 minus 602,000. Obviously, that's a negative number. That means we have an impairment loss. That means the carrying value is above the fair value. That's not good because we want to carry our investments at fair value. All right, so that impairment loss needs to be recorded in the income statement. We would do so by recording $52,000. That's going to decrease net income. Now, you're probably wondering how this impacts the carrying value of the investment as well as what the journal entry would be. It's very difficult. It's not as straightforward as you may think. We're not going to get into it because it's very, very unlikely the CPA exam would test you on that. The important thing to understand is that we do have an impairment loss. It is recorded in the income statement, and there will be a decrease to net income for year 3. So remember this example, and you'll be covered with anything related to impairment. The final thing to talk about is what if a company accounts for an investment under the fair value method because they own less than 20% or they don't have significant influence, but they decide, hey, this investment's going well, I want to buy more. So they buy more, and now they're above that 20% threshold. So now they would use the equity method. Well, it's really quite simple. We just need to understand the journal entry to record that investment, as well as understanding that retrospective treatment is not required. So let's just look at an example and make it super simple here. So our example says that during year 2, Scale Corp, they owned a 15% interest in Blue Corp. Things went well, and during year 3, they decided to acquire an additional 20% interest in Blue Corp for $500,000. So obviously 15% plus 20%, that means they now own 35% based on that rule of thumb, right, which is 20%. We're now going to use the equity method, and the question tells us that. They're now going to account for this investment under the equity method. So what journal entry would they record on the acquisition date? Well, all they would do is debit an investment in investee for $500,000 and then credit cash for $500,000. As we had previously discussed, we do not need to make any retrospective adjustments based on this switch from the fair value to the equity method, just accounted for prospectively going forward. So that's fairly straightforward. You could see a multiple choice question on that, but just understand this example and you'll be set. So that wraps up our discussion on the equity method. The key takeaway is going to be those 5 steps and mainly just understanding how to perform each of those 5 steps, because that is really what the multiple choice questions and simulations are going to focus on. The other big thing is being able to understand when to apply the equity method versus, say, the fair value method or the consolidation/acquisition method. So always be thinking about, does significant influence exist, and do they own between 20 and 50%? That will be sort of the giveaway that the equity method should be used.